Well, to me, the only thing more addictive than Italian lasagna and Mexican guacamole is some Indian naan bread. Have you ever tried it? If you have, then you know what I mean. Yum-a-dum-dum for the tum-tum-tum. On today's ETF Battles, we're taking a road trip to India. We've got an audience-requested quadruple-header between funds tracking stocks from India. This is going to be fun. It's Blackrock versus WisdomTree coming up right after this. This is ETF Battles. I'm Ron DeLegge. Welcome to another brand new season of ETF Battles. This is season 4, and we're glad to have you with us. Keep your excellent ETF battle requests coming. Send us your ticker symbols in the comment section below or on our Twitter feed at ETF Guide. If we choose your battle, you win your choice of an ETF Battles coffee mug or a shirt. We still have more spots for our upcoming retirement planning webinar with fresh 2023 updates. Attendees will also get a free ebook titled 60 Smart Ways to Retire Better. Hit the registration link below in the description section to join. Attendance is free to all of our audience members, but space is limited. With over 1.4 billion people and counting, India has already surpassed China as the globe's most populous nation, according to the World Population Review. India is also armed with 27% of the world's Gen Z population. It has a middle class that's set to double by 2030 and 25 million new smartphone users added every single quarter. So the stage is set for India to enter a global golden age of economic and digital growth. So how can investors get a piece of the action? Well, today's ETF battle was requested by a viewer named Harsharo. How do you say it? Harsharo? I think that's how you say it. And it's between 3 India-focused ETFs from Blackrock going up against 1 India ETF from WisdomTree. Now, each of these funds, as you're about to learn, takes a different approach to investing in India. But the question is, which is the best choice? Judging today's contest is a formidable duo. We've got Cinthia Murphy at the ETF Think Tank and James Seyffart at Bloomberg Intelligence. It's great to see both of you. Welcome to Season 4 of ETF Battles.
Hey, Ron. Thanks for having me.
Thanks for having me, Ron. Happy to be here.
So our 4 battle categories are cost, exposure, strategy, performance, and then the mystery category, where you, our judges, can pick that single factor or multiple factors that you feel are critical to today's contest. Our judges can also nominate wildcard ETFs if they feel there's better choices elsewhere, or they can opt for split decisions. It's completely up to them. I've got the scorekeeping chores, and at the end of the show, we'll declare an overall winner. Keep in mind that none of the battle outcomes are ever predetermined or known in advance by myself or our judges. So it's sisters before misters. Let's kick things off with Cinthia. Get us started, please, on the first category, cost.
So on cost, I am giving the win to INDA, which costs 64 basis points a year, which is a lot cheaper than anything else that we're comparing today. You know, the others are in the 80s and 90s, so 64 doesn't sound cheap in itself, but relatively it looks better. India is also the biggest fund. It has $5 billion in assets, so I am going to give this one to India. Easy win, I think.
Thank you, Cinthia. James, you're up next. How do you see it when it comes to cost?
Yeah, I have to agree completely with Cinthia. I mean, India is the low-cost option here. It's the largest fund. But ironically, all 4 of these are, if you look at ETFs, if you're used to looking at ETFs, especially if you're looking at domestic U.S.-focused ETFs, they're pretty expensive. I mean, the cheapest one, like we said, is India at over 60 basis points. The others are over 80, over 70. They're all up closer to 1% than most ETFs people are probably used to looking at. But that said, India wins this pretty clearly.
That takes us to our next category, which is exposure strategy. So, James, you're still up. Give us your analysis, please.
Yeah, so the 3 iShares products, if you look at Indy, INDY, that holds only 54 stocks, or 50-ish stocks, I would say. So that's a more concentrated portfolio. It's also the most expensive at 90 bips, which we kind of just spoke about. You've moved on to India. That one is going to offer you a much broader exposure, over 100 different stocks. Those 2 are both focused mostly on large caps, but then you go to SMIN, which is also iShares, and that's a small cap version. You're going to get way more exposure, but obviously you're exposing yourself to small cap India. And finally, you go to EPI, which is also, it's going to give you more broader focus, but it uses fundamentals and earnings to determine how it weights its holdings. So you're going to get a more differentiated exposure. It's going to give you a bit of a value tilt, which has been very good so far in recent years as rates have risen across the world. So for exposure and strategy, I'm going to lean towards EPI on this one. And yeah, I'll pass it over to you and Cinthia.
Thank you, James. Cinthia, you're up next. How do you see it when it comes to exposure strategy?
Yeah, I agree 100%. What's interesting about the BlackRock trio, the iShares trio, is that one is your 50 largest Indian companies. The S-Min is your smallest Indian companies, and India is that middle ground, large and mid cap. So it's almost like the three of them are kind of complementary to each other. And EPI stand on its own. It's a blend of small, mid, and large cap. About 67% of the portfolio is large caps. So it offers a more blended, diversified approach. I do like India as well because I think it's a great fund and it has enough of a diversification there. So I'm kind of split India and EPI in this category.
Okay, we got you down for split. That takes us next to performance. And Cinthia, it's still your turn. Give us your analysis.
Yeah, on performance, to me, it's EPI all the way. To James's points earlier, the way this fund is built, that earnings screening, earnings weighting, that gives it this value tilt. It has performed really well. It's outperformed in 1, 2, 3, 5 year time ranges when I was looking. Now, this year specifically, it's been really interesting to watch SMIN. So the small caps have had a momentum there going earlier in 2023. We don't know if that's going to last or not. But in the longer time horizon, I like EPI in the performance.
James, you're up next. How do you see it when it comes to performance? Which of these ETFs stands out?
Yeah, so there's been a time period where S-Min has outperformed. This is one area where a lot of times we look at some of these ETFs and these ETF battles, and they offer very similar performance, but that's really not the case. If you look at India and Indy, they offer pretty similar performance despite different holdings. But EPI and S-Min offer very different exposures. That said, EPI wins the performance battle here. Again, I mentioned briefly before, it uses fundamentals and earnings. It has a tilt towards value, and that has been a winning category over the last couple of years.
Our mystery battle category is next. This is where our judges can pick a single factor or multiple factors to make their persuasive arguments. So, James, what is your mystery battle category and which of these ETFs wins it?
Yeah, I'm going to go with an age-old category of trading liquidity. So when I look at this, depending on how big you are, the trading liquidity isn't that important, especially for most retail investors. But if you're looking to trade in size, or you should really always be using limit orders, to be honest. But India blows everything away, followed by EPI. But India just has tighter trading spreads, much more liquidity throughout the day. There's a lot more trading volume that happens in general. And it's in basically a category all its own, a tier all its own. So I'm going to give it to India for that category.
Cinthia, you're up next for your mystery battle category. What is it, and which of these ETFs wins it?
I am actually going to go with a weighting strategy, which is really sets EPI apart. I think this earnings versus market cap weighting has really worked well. And if you look at the latest, market outlooks for India and everything that's going on, everybody's talking about super high valuations, like historically high valuations in India relative to other emerging markets, relative to the rest of the world. There's a lot of risk to just, buying your largest companies there right now. And with this earnings weighting, you get not only this value tilt we've mentioned several times, you get the quality filter in a way that really has delivered performance over time. So I think for this space, when you're talking like a risky emerging market, I love the idea of this quality screen through the earnings, as well as the value tilt from the portfolio.
We're going to give our judges one final opportunity to weigh in with their overall battle winner. How will this go down? Cinthia, you're up. Give it to us.
So if I really have to pick one, I think for right now, I like EPI best of all. But in truth, EPI and India are a split for me for the various reasons we've talked about, from the importance of your execution, so the trading liquidity, but also the importance of the portfolio construction, the importance of diversification, cost. I think these two are very interesting funds to access Indian equities. So I am going to give it to India and EPI.
James, your final opportunity to weigh in with your overall battle winner.
Yeah, so I'm pretty much with Cinthia. I view India and EPI as being in a league all their own and much better than INDY. SMIN, like if you're for some reason you really want to bet on small cap India, I mean that's your only real option if you're a U.S. investor. But if I had to pick one, I also would probably pick EPI, but I don't think you could go wrong picking India for all the different reasons we spoke about. And I mentioned before when I talked about trading liquidity, yes, there's way more trading volume in India, but the trading spreads that we see in EPI are very comparable to what we see in India. So even on that case, they're very comparable. But like I said, for all the reasons that Cinthia mentioned and the reasons I mentioned, if I had to pick one more diversified, I like the strategy of using earnings, getting you different factor tilts. So I'm probably going to go EPI as my favorite here.
Well, our judges have spoken, and according to my battle scorecard, EPI is the winner. We're going to go with EPI just because we had two judges weigh in favor of that. Although, you know, I was on the fence. This was almost a split decision, but I think our judges made some very persuasive arguments. Obviously, EPI having that quality filter, the value tilt, which in this current market environment has been quite beneficial to performance. But then at the same time, INDA, as James had mentioned, has advantages when it comes to trading spreads and also in terms of market coverage, just a little bit more broader. And so, again, great job to both of our judges for pointing out the differences and helping us decipher between these India ETFs. Very thoughtful analysis, and well done with today's India ETF skirmish. We couldn't have done it without you.
Well, thanks for having me, Ron. Always a pleasure.
Yeah, this was fun, Ron. Thank you.
Be sure to visit the description section below for research links to our judges. And while you're there, check out the link to our program sponsor, Direction Investments. You'll also see viewer resources from us with links to upcoming events, including our retirement planning webinar. Thanks for watching ETF Battles. I'm Ron DeLegge. We'll see you next time.